Hi everybody, Brian here from quantlabs.net. I wanted to go over a article that seems to be lighting up everywhere on social media regarding this article put out by Bloomberg. Title of the article for those, this is on Bloomberg.com. On the podcast, basically the title of the article is Master of Robots left AQR, now he's coming for Wall Street. Who we're talking about is somebody, Marcos Lopez de Prado. I probably got his name wrong, of course. A few years ago, I put out this video on my YouTube channel of his PhD papers. And the article or the video on my YouTube channel, Quant Labs, is called "What Real Quant and HFT Looks Like from Advanced PhD Doctorate Book." So this is pretty intense stuff from the math side. So he definitely knows what he's speaking about. So in this article, he's been ranked Quant of the Year in 2019. He worked at AQR Capital. Looks like he's leaving or has left. Here's some of the highlights I came away from this article. First, he says there is a tremendous hype. Very few people have a track record. It's not helpful. I agree with that. I've been trying to get my own track record online with my own Python scripts. I've already put up a video on that last week. It's a mess to maintain and a mess to work with. So basically what I'm going to be doing is just cutting out all the crap and wasting my time on developing that technology to post it on my own website. As I said in my post, it's useless to even do it in a Photoshop skeptic world. As a result, I'm just going right to linking these services, these third-party services, up to the trading accounts, live trading accounts, which is obviously for credibility as well. He always says, my ambition has always been to help modernize finance and other disruptive solutions to investors. The best way to do this is with his own setup. So I guess he's probably talking about insider experience in some of the large firms he worked with. I think there was Citadel, AQR, and some other ones as well. So he's probably basing his experience off of that. I can't really say. I've never been working in that environment. Also, this is no different than when you see the frat boys on YouTube and Facebook with their stupid Lamborghinis and their pimp and hoe lifestyle, hyping things. And it's probably the same in the professional institutional world as well. The problem is computer-powered strategies are struggling, and to live up to the hype, which they aren't, there's no credible track record for that. So obviously there's no transparency. I will say one thing though, you can see if a firm's working or not based upon how fast they're growing, how much their assets are under management. You look at companies like Renaissance Technologies or Sigma 2, was it 2 Sigma? You definitely will have those problems, but as those funds grow, proprietary I might add, they must be doing something right. So that's just a caveat putting out there. Also, his diagnosis, fund managers are routinely throwing data at a robot without forming a theory or theme to why they're doing it. If a backtest suggests investors should snap up stocks on any given day of every month and sell them a number of days later, only a joined up rationale for the trade will work in live markets. So this comes back to what I said about backtesting. There's so much emphasis on backtesting, it becomes kind of a joke. If you see my recent webinar I did earlier this week, if you watched, I said the same thing, that you really got to throw your strategies in at least live market data, not on back-tested historical recorded data. You'll quickly find how quickly that same strategy may not work in certain periods of time and break down, and you won't even know why. That's the sad part about it. So he's saying the same ideas here. You can't just take a strategy that you back test and put it up against all stocks and try to run it every day, every month, because it probably won't work over time. Also, he says without this theory ML interplay, investors are placing their trust on either toy models. Of course, you read those in popular research papers coming out of university level, PhD level thesis, or high-tech horoscopes. I love his language here. He also did an article. There was an article I posted, I think last week or 2 weeks ago, about how he was referring to how research funds are using companies like Quantopian or anything like that, Numerai, where they run contests through those platforms, and whoever comes up with the best hypothesis on the data for finding patterns, because the firms that are doing this know the patterns, they know the data, they don't know the time period, they don't know where the data is coming from. But if you run it through just basically some kind of platform like I said, Quantopian, the people that participate in this contest will not know what assets for, what time period, is it news driven to make these patterns happen. It's just basically on pure market data and price. So the ones that win those contests will then get contracts for doing the research with these papers. It's a much cheaper way of finding rock star so-called researchers, and you just pay them no different than temping or contracting them out, instead of hiring them and paying gobs of $500,000 or $1 million plus when they produce maybe out of the 10% that you have them on staff, maybe 10% of them will basically produce something. So in essence, that's the direction we're going. And the best part about it, what he calls these kind of researchers through Quantopian and all these other sites, he calls them bedroom quants, because that's what they are, really. No education. Some of them, they may just do it for the love of it or just because of the hype. So this highlight here, referring to toy models and high-tech horoscopes, is just that. But actually, the winners out of those contests are the ones, the creme de la creme. It's not natural in finance. History of finance has been discretionary. Portfolio managers need to run the place. Because I have always said, there's three types of ways traders are having their backgrounds from, either from math or from computer science or from actually trading. So usually, from my experience, the ones that went out are the discretionary portfolio trading managers or portfolio managers, because they have the experience and decades of experience to know when there's a news story, to know if there is something happening in data that the public, don't know. They can go out and be able to think like a trader and be able to relate this and this and this from an industry point of view, to be able to come up with that theme and then run data against it and run a model for it. So traders know that because that's their experience, and they are able to see something in the future related around trading that mathematicians will never see, nor techie computer scientists will ever know as well. It says these firms have fitted quants, and people say, I'm a quant. I'm not a quant by no means. And then they become the new discretionary portfolio managers. And that's true what's happening. And that's why you're not getting the performance. Here's the proof. In the article, what you'll find here are the charts. Here, AI hedge funds have lagged their peers in recent years. So when you look at this chart, it's pretty bad that if you are doing AI hedge funds, artificial intelligence hedge funds, by it, machine learning, up until 2017 there was a peak there, but they've lagged in terms of performance, and that is normalized, found that Eureka Artificial Intelligence Hedge Fund Index and Eureka Hedge Fund Index. So these are showing you the returns. It's nearly double with discretionary. So that's still king of the boat. So do understand that, and that's not data I just come up pulling out of my ass. That is actual data that is in this article. Also, I find this very fascinating here. Let me just go back to my notes here. So one other thing I did not mention, another chart. This right here is Greenwich Associates survey market participants and how they see artificial intelligence affecting trading. 41% see it in algorithmic trading. Now, what does that mean? Algorithmic trading can mean anything. Portfolio optimization, does it mean actual forecasting trades? Is it actual handling the automation of the trades and risk management and all that? That's built in. This could mean anything. Facilitating analysis of news, content, and data. I could see machine learning without a doubt really being important here because you can scan the data, pick out the big winners on a macro level, and be able to make judgment calls off of that. The other one that I think is being underappreciated on the power of machine learning is risk management, because in my case, as an example, sometime my next project at some point is to know, if you haven't seen my last video that I did post through my Quant Members Elite, you will know that I talk about in there that you probably would want to set up a daily cap on your trading profit, and definitely on how much loss you're willing to take on the downside, because this is really critical to preserve your capital in your trading account, which is your number one goal. Everyone thinks that number one goal in trading is to make money. It's not. That's number two. Number one is to preserve your capital. So this is where machine learning is very underappreciated, because you can use machine learning to calculate with a number of factors what your daily cap should be and how much loss you're willing to take total on your trading system or entire portfolio. And then once you hit those daily targets, either on the upside or the downside, you shut down your system and start over again. And yes, there will be the Nimrods that will argue that, and that's fine. But when it comes to probability, it always says that once you hit your cap on at least the upside, there is a high probability you will not be able to retain it. So you just shut down and start up again the next day, because you have to set up daily profit target levels. And that's where machine learning really, really, really shines. So that's what I'm thinking right now. And I thought I'd introduce you to that. But good for the good doctors, I call them, outside of Dr. Ernie Chan, for getting that award. He sounds like he's on a good mission. And don't think this guy's based on hype. He knows his stuff. Check out that video to get a preview of the book right here, which was his, as you said, doctoral thesis. Okay, so there you go. Hope that helps you out, and we shall talk to you later. Don't believe the hype. And as I mentioned, also Quant Elite, Quant Elite, Quant Elite. If you want to be a member, I will be putting a lot more exclusive content in there. All you got to do is go to the Quant Labs store. You can get that on any of the links on the site. You just come under store. And in there you will find a link to the Elite right here. And what we're doing is it's 3 years. I got to get rid of that. 3 years. I'm going to drop it down to 2 years, and then eventually only 1 year, one annual term for $9.97, which is really cheap. And then from there it'll go up, because we're just on the verge of starting to do all the Facebook advertising. Once we get some success with it, all that stuff will be moving ahead very quickly. Okay, so that's pretty well it. Hopefully you enjoyed this video. Let me know what you think, and we shall talk to you later.